communicating. You can hear me?
Yes, you are. I've actually said the recording, so you can start the class.
All right, thank you. Okay, now I want to believe our traders we had a good week so far. I'm glad that at least I am through with my the sickness that I was undergoing last week. I'm over with it, and now I'm back to normal business. So I would wish because from the topic that was shared in the notice, we were to talk. We are to look at 5 minutes scalping using 5 minutes for the purpose of trading, and actually that minutes using it for the purpose of determining the market structure. We want to shift a gear a little bit from because ordinarily we have been scalping using the 1 minute for scalping and 5 minutes for market structure. Hello? Okay. Yeah, so maybe I think also it would be good if also we can hear some experiences of what our experiences has been so far using the system that we've been using for our scalping, so that even as we step up the gear, then we can know whether we are comfortable or whether we can try something else for the purpose of us actually enhancing our trading experiences. So I hope, guys, this week I have not the reporting has not been very has been quite low, and probably I think it will be we can give each one of us maybe a chance to tell us what their experience has been so far this week with their scalping, so that then as we proceed, then now we can be together. We'll pick on individuals, not in any order, but as they appear on my screen here. Excuse me. Maybe Alex, if you have been trading, please, if you can share with us what your experience has been this week. Is Alex on board? Okay, as Alex prepares, maybe there is a honey. I'm seeing
Jackson. Sorry, Jackson.
Yeah.
I was muted. Yeah, thank you very much. Good evening, traders. I think I just wanted to report that I've not been trading, so I'll probably not be able to share anything.
Okay.
But I've just been following up the studies. There's been I've still been down a little bit here. Yeah.
Okay, thank you, Alex.
Yeah. Yeah, thanks.
All right, Honey, is she? Honey appeared from the screen. All right, Elizabeth, please, if you can share with us your experience so far this week. Elizabeth, maybe as she prepares. Patrick. Yes, Patrick, it's your turn. Good evening.
Traders.
Good evening. Louder, a little bit louder, Patrick.
Okay, can you hear me now? Is that better?
Yeah, you're audible.
Yeah, okay, from the experience I've had this week, since the introduction of our three when coach introduced us to using the 3 screens, I would say it's been quite an experience, and it has made a change. Actually, it's been a game changer in trading.
Yes.
So far, I feel very, very comfortable, and I'm able to at least trade as I watch how the market is moving.
Really.
So that has been my experience this week.
Good. Yeah, indeed, you have been posting some positive returns. Congratulations. That's the way. Right. Phoebe?
Thank you.
Phoebe, you have something to share with us?
Yes, I've been trading, but I've also been unwell. I've not posted. I've made losses after making gains. That's where I am at.
Right. Don't give up. Don't give up. Let's continue polishing our act. I'm sure we are not yet there, but we are on the track. Thank you. Nigel? Nigel, you can hear me? All right. Then I think we'll leave that at that. We just proceed with the today's topic. Now, we are all scalpers, of course, and that is the strategy that we have come to learn for actually using in the market since we were introduced by the coach, and it is what he has been trying to perfect. And still, it's bit by bit as we move on, and as we master one level, then we move to the next level, so that we can be all rounded and we can be able to actually to be very good scalpers, right? So because here scalping as we know it, it is for one, it is a very fast. It's a very fast method. It can be stressful. I'm sure if you have been trading, you will agree with me that actually scalping can be stressful because the action that happens there right under your watch. Sometimes when it's going against you, you all know actually what you go through. So it is something that then we looked at and we said that let's enhance it a little bit to also minimize this, to minimize the stress level and to enhance also the productivity. Yeah, because when you're trading at 1 minute, the trade cycle for 1 minute, it is usually very short. It moves very fast and it comes back very fast. Yeah, as compared to the trade cycle for 5 minutes, using a 5 minutes chart for the trading purposes. Those movements are somehow contained. You will realize that when it is moving, it is truly moving at a slower pace, slightly slower than the 1 minute chart. But when it moves, it is a little bit more certain, and it moves with some kind of permanence, which you can be able now to use actually for you to place your trades. And again, the duration, the 5 minutes, you stand a better chance to be able to actually hit a higher level of pips. Like for instance, when you're scalping at 1 minute, as the coach has always said, you are likely and you target to get 5 pips for every trade that you take. You stand a chance actually not to get that 5 pips. Why? Because of the nature of the movements in 1 minute, in a 1 minute chart. But for a 5 minutes, you can comfortably, if you have identified your setup clearly and you have seen that now the market is actually moving, chances of you eating the 5 minutes is almost guaranteed, because the 5 pips, not 5 minutes, is guaranteed, because the cycle for a 5 minutes time frame chart, it is a little bit longer, and therefore it gives the room for us to be able to hit that higher amount of pips. Yeah, and if you are trading, when we are trading and actually you look at it, you you handle the fewer, if as a scalper, if we can handle fewer entries with better yields, it is far much better than entering in so many trades with much less yield, or to achieve the same yield that would have achieved that if you are using a higher pips, but then you end up fewer. Yeah, when you look at on the side of the commissions you are going to pay, when you look at the possibility of you entering so many, and then the market actually turns the other way around. Yeah, you can imagine having 60 entries at one go, and actually the market has really turned against you and it is moving away. Yeah, that is when now panic starts. But if there were fewer, like 10, 15, 20 at most, thereabouts, those are within levels that you can be able to manage without really panicking, and still be able to come back. And even if you incur some losses, you'll be able to recoup. So when you look at then the 5 minutes trading at 5 minutes time frame chart, it has more advantages as compared to doing it at 1 minute at 1 minute time frame. Okay, so then that is what we want now to try, so that we minimize. I'm sure we have all gone through this process. I don't imagine there's one of us who has not gone back, forward and backwards. Yeah, it has been a back forth kind of a thing. We want to try to change a little bit our trading style, so that we see whether we can be able to maintain that consistency to an extent that now we can be able to grow our capital to the levels that we have always desired. Because if today you make, for instance, $50, then tomorrow it hits you back, you end up getting maybe $100 as a loss. We will never be able to move towards our destination that we wanted. And I'm sure this one, sometimes it can be demotivating. When you feel like you're in control, you're moving in the right direction, then all of a sudden, then it kicks you back. Then it can easily become a source of demotivation, and we want to overcome that. So traders, we've thought that it's good that we try and now change our trading, our scalping strategy to use 5 minutes for trading. Then we use now the 30 minutes chart for determining the market structure as it were. Okay, so it is something that we want to whatever. What I have here, the literature, much of this is just has to do with the scalping in general. I will not want to delve much in it. I'm sure it says it's being recorded. You can be able to get it from there. But what I wanted to point out is that I want to particularly to go straight to point number 3, understanding market conditions for scalping. Yeah, understanding markets conditions for scalping. When we are doing scalping, whenever, if you have noticed, and actually not even noticed, I'm sure this is something that we have all experienced. Whenever the market is actually trading, either upwards or downwards, for scalpers, it is usually a field deal. It is usually a field day. Yeah, you will be able to just collect enough, pips. Whenever the market is trading, whenever you know that it is actually uptrend, you will confidently be able to make your buys whenever you get the opportunity. Unlike in the recent past, whereby actually the game has a little bit has changed, and I'm sure all of us at some point we have been overturned by the market because of the nature of the market as it has been, the raging market. That one is it has been a bit tricky for us to scalp, but it is because when you look at the statistics, they say that the markets trade for only about 20% of all the times, 20%. So 80% the market will be ranging. Then that means that if we have to be in business, we have to change and we have to adapt into different market conditions, and particularly the difficult ones. Ranging market is difficult for a scalper because you know, the trade cycles are a bit short. Yeah, they are a bit short. So by the time that you are finishing with your buys, already the market probably has turned, and then you are left with buys which are hanging. So this market conditions, it is something we have to master in our scalping nature. And also while we are at that, maybe I may also want to mention something that personally I've after looking at the markets, I've also come to realize when we are trading in a ranging market, even if you are trading at even if you are trading with at the 5 minutes time frame, I think it is advisable still to scale down to scale down the pips. That is the take profit that you have to be taking instead of 5, because when you are doing at whatever, we can comfortably, if the market is trading at 5 pips, it's good enough when you are trading at 5 minutes time frame. But if it is in a ranging market, sometimes it is advisable to scale it a little bit down, because thereby you'll be more sure to actually avoid some of your buys or sells being left actually on the far end without them being hit, and therefore you start incurring the losses. So it is important, traders, that you look at, be open, and scalping requires quick action. Look at the market structure, the way it is behaving, and adjust accordingly. Adjust accordingly so that you are operating within levels that are realistic. You may aim too high, but you end up getting nothing. Actually, you end up losing a lot, because once you have entered once you have entered the trade, then you have already started incurring losses or profits, whichever way. But most of the times, it's the losses, and they accumulate at an accelerated rate, if you have noticed. And the commissions that you have incurred, because the moment you have clicked, already 0.08 has been taken away from you as commission. So to avoid all that, then it is important that we operate in an environment that we keep checking using this 30 minutes, whatever the 30 minutes time frame. It's going to help us to remain focused as to whether this market is changing, whether the market is trading, or whether it is ranging. It will be very clear, and therefore we can be able to adjust that. Maybe there I beg to maybe I might have, that might differ with what the coaches always told us about keeping a uniform, going for a uniform pip size. Yeah, there I found it a little bit practically. I found that a little bit tricky, in that if I insist on having five pips for a ranging market, then chances are that most of them will be left hanging, and that will be a disaster at the end of the day. So this thing is a question of managing it, looking at what is on the screen, and making decisions, informed decisions for that matter, and actually taking your trades when you have a clear target. Now, why 5 minutes time frame compared to 1 minute? There is 3 advantages that I identified, and I think I want us to share that. Then after that, now I can be able to usher in the coach to actually make some clarifications on this issue as we proceed. One, that when you look at the volatility in 5 minutes, it is less spontaneous, hence less risky as compared to the 1 minute time frame. Yeah, and that is true. If you look at those charts, particularly when the market is really moving fast, it can be confusing. It is eating up. Some of them have very long, candles, and others have very long tails. So all that kind of a thing, playing at your highs there, it can be a bit confusing, and it can many times it will end up actually throwing you off the course, because you will end up making wrong decisions, being informed by those kind of movements. But then when you look at the 5 minutes candles, they are a little bit more contained. They are better, they give you the room to really to increase the probability of you getting your decision right. Secondly, that the setup cycle for 5 minutes scalping allows the trader to target a higher number of pips, e.g. 5 pips, with a high degree of success. Yes, we will be able now to increase our pips. If we are trading at 5 minutes time frame, we will be able to comfortably aim at getting five pips every entry. And as I said, that will enable us to be more careful, to be able to enter just enough with good yields. Once they hit, you'll be able to get good yields, and you'll be able to get your 1% very comfortably. Very early in the morning, you are done and you are gone. Yeah. So the 5 minutes scalping, it gives us that room to be able to be able to make more. It increases the probability of us actually getting it right and minimizing on the exposure, because the more entries you make into the market, that is exposure, that is risk. You are exposing yourself, because all of them, if they go the other way around, the opposite way, then you know very well that now that is beginning of trouble. But if you have a few, you key in about 20, 15, whatever, then once you are with the profit, you can go again, you wait for another setup, you take another 15 to 20. By the time you do that, 5 times or 6 times, you'll have hit your 1% daily target. Number 3, that 5 minutes chart is less stressful to analyze or deal with as compared to 1 minute chart. Yes, that's what I find myself whenever I look at this. Yeah, 1 minute is too, it kicks you up and down, and to the extent that sometimes it can get you off the track. Yeah, but when you look at the 5 minutes chart, it seems to be a little bit more contained, and it gives you room to think and be able to do your analysis well, and be able to take trades with confidence. And I think that is the desire of each one of us. It feels good when you are making entries, and you know that after you have made them, you'll not step back and say, what did I do? Or you start regretting, why did you make that decision? And clearly you can see the market is not, it was not for buys, or else the best decision would have been to stay away, to stay back. Yeah, the best decision would be to stay back, not to do anything. But because the 1 minute chart seems to be moving fast, or telling you that it is now it's time to go up, then quickly you enter, then you realize that it was not, it was actually a fake out. Yeah. So that is the reason. Then these are some of the advantages that we think that they will help us to ground, to trade in a more polished way, and most probably also help us in actually reaching that target. Remember, of the challenge, we want to enhance that and see whether we can be able to reach the doubling target that we had been given all along. Otherwise, I think that is the little that I wanted to mention for now. I will usher in the coach. Probably, I'm sure he has 1 or 2 more to add to what I've said.
Okay, thank you, guys. That was very good. I guess I'm supposed to say good evening. Yeah, good evening to everybody. It's been a while. This is good, and I want us just to be conscious of the fact that we are trading the forex market. Hence, like I told you guys from the word go, there are very many variables, but the way to make money is to be able to take advantage of the movements of the market, where the movement is going up and down, up and down. I know that I put you guys on a very tight leash when I suggested the $1,000 challenge, which I can also say confidently that now I'm confident all of you guys, most of you, if not all, can actually trade and grow an account. Now the challenge that I gave was deliberate, but it was also very tough. It's like a teacher setting an exam, and he knows the exam is tough, but nevertheless sets it anyway to more or less give you guys a feel of what the real life is all about. So if you have attempted the doubling challenge and you've been able to at least even make 10%, okay? 10% of 1,000 is $100. If you've been able to make 10% within a very short time, I can tell you for free, okay? Maybe nobody will tell you, but I can tell you as your coach that you are able to trade a real account. Now, let me just give you some statistics. Most traders, okay? Most traders, let's first start with the banks. The banks, when you put some money, they promise you a return of about, 10%. On the high side, you might get 12, 14% in a year. On the lower side, it could even be 8%. So this is percentage in 1 year. As we're not talking of 1 year, we haven't even been talking about 1 month. I have been trying to challenge you guys to do just 1% a day. Now, 1% per day on average, I don't care what capital you have, but even for a small account like 1,000, okay, 1% per day is only about $10, which means in 5 days, you can easily get $50, all right? What I did was deliberate, but more or less to train you to learn how to grow an account, which means that now, if any of the other variables are changed, then you are in the money. For example, 1, if the capital you're trading changes, so suddenly you have more, you actually can produce more. If you talk about 1% of 2,000, that will be about, $20, all right? Then I had actually constrained you guys that said, okay, you can only do 2 pips. Well, 2 pips is a tough practice. But yes, I did that deliberately, but it was okay to teach you guys some kind of discipline. And remember, I shared with you guys that I was using the price cycle. And maybe, who knows, down the line, some of you guys might come back and actually appreciate the scalping in the, in the 1 minute. Why? Because what it does, it puts you in a certain mind frame or frame of mind. Okay, I'm gonna get to the charts here. All right. So essentially, what I'm saying is, if you look at a typical 1 minute time frame, you'll find that the price cycle, again, price cycle, remember what I told you guys, was generally the movement from the high and the low. Okay, for example, let's go today. All right. So this should be considered a price cycle. Let's see if we can. So if you forgot, the price cycle technically is the movement from the low to the high. Okay, this is a typical price cycle. Okay, and then it goes down again. So for the last couple of days, it's been consolidating. So by the time it actually moves to one price cycle, it hasn't covered much. Okay, so that is what we mean by the price cycle. All right, so from the low to the high. So, and this is what I've been saying, you are only getting, in terms of statistics, we're only getting about 2 pips of this move. Now, this move, typically for a 1 minute time frame, is about 10 to 15 pips. Okay, so let's look at the 5 minute time frame. A few things will change, but the price cycle will be a little more on average, a little more. All right, so come here. Okay, and then I'll change this to the 5 minute time frame. Okay, so for the 5 minute time frame, things change a lot. And let me see if I can. Okay, so basically, like from here up there, that would be a price cycle for the 15-minute time frame. So this would be the price cycle, okay, from the low to the high. Okay, you can see they are almost the same. Okay, so those are the what you can say the price cycle in a 5-minute time frame. So if you calculate the average, again, average varies. So I'll just click on this and see if we can measure one. So like from that low to that high, it's about 20 pips. So I always say between 20 and 25 pips, will be your typical 5-minute, time frame, price cycle. So this is more on the lower side, all right? Let's say from here to there, okay, about 25. So hypothetically, let's pretend that the price cycle is about 20, okay? As you can see, it's from 20 to 25, but let's just pretend that for the sake of our discussion for our class, it's about 20 pips. Usually, I think it goes up to about 25 or even more, okay? It could also be as low as 15, yeah? So what we are saying is now with this new price cycle, okay? Remember before we had between 10 and 12 or 15 around there, okay? And we were targeting for 2. So 2 was basically 1 out of 5. So what we're saying is here, ideally it should be around 20, 25, when the market is doing well. But what we're saying is we want to target now 5 pips. Now, 5 pips out of 15 or 20 and 5 is actually from maybe a third to about a fifth also. 1/3 to about 1 out of 5. On the higher side, it's still the same as the first one here, okay? On the lower side, when things are not very, very good, it's about a third. So we are saying if this is the normal price cycle, okay, so you divide it into 3 parts. You still have a higher percentage of hitting this target, okay? Target A versus target B versus target C. So if the market is starting from here and moving up, you are still more likely to hit target A first before you hit B, before you hit C, which means in this price cycle, if you target only 5 pips, you're still doing okay in scalping. Now, number one, that's the advantages. So number one advantage is you get more pips, you get 5, versus 2, all right? Second advantage is now the markets are a little more slower, for lack of a better word, slower, hence gives you time to plan. Unlike the 1 minute is moving very fast, and sometimes you don't have time to plan. But now you'll actually see, you'll be comparing the 5-minute and the 1 minute vis-a-vis, the 1 minute and 5. You'll find that this is actually much slower. And some of you might start getting bored. You might even go back to the 1 minute, which I'm glad now you know how it works and you can work with it. But ideally, the whole idea of moving to the 5 is then to allow you a little more time to think and plan. All right? And the third one, which is very important, probably as important as those, is to actually clean up your entries. It allows you to clean up your entries. Okay? So you find that in the 1 minute time frame, sometimes you find yourself entering the market when the market is actually going down. It has clearly shown it's going down, and you're entering a buy. Oh, sorry, you're entering a sell. Okay? So hopefully the 5 minute will give you enough time to actually clean up your entries, because it is the wrong entries that lead you into losses in scalping. So what am I saying? what we're saying is we are relieving a little more pressure from you by allowing you to take more pips, to have a slower market where you can actually think, have some space to breathe, okay? And then the third point, which is very, very important, is now you clean up your entries, have better entries, you know? Whereas before, we knew where we're entering and so on and so on. Now you'll have a little more time to think again before you enter without much pressure. So what's the results of this? The results of this is, one, it will allow you, if you are diligent, all right, it will allow you to okay, basically allow you to make number one, maybe more pips, more. You'll have more pips because now you are doing 5, okay, 5 pips. So whereas before maybe you were doing 50, okay, 50 pips, but now you can end up doing more pips with a 5-minute time frame. Why? Because of course 5 is more than 2. Okay. The other advantage is then it will allow you to reach your target maybe a little earlier. Okay? If you have a daily target for yourself, you'll hit your target more likely a little earlier. All right. And probably the third advantage is it is less stressful. Okay. You might even enjoy it too much because again, you're getting the volatility of the scalping, but also you have the luxury of the longer time to plan. All right. So those are the pros. Now, the cons, okay, is unlike the 1 minute time frame, okay, you have to wait a little longer to hit your target. Okay, so the wait will be longer. So one longer wait to hit your target. Okay. Again, it depends on how you look at it. Well, it's 5, excuse me, 5 pips. But then if you do enough trades, okay, then you can be able to hit your target easily and quicker. That's number one. However, you will also, point number 2, you will not have as many trades as before. Number of trades, because now you're taking longer pips. So whereas before maybe you were able to take 100 trades, well, right now because you're taking 5 pips, your margin, you'll be hitting your margin sooner than later, which is fine. It's a trade-off. So instead of doing 100 trades, you might end up doing maybe 20 trades. Okay. Now the other consequence to that is then it means you have to plan better. Okay, to plan. Now remember, I told you guys before that when you are doing and you look at your lows and high, okay, or even for that time frame, you apportion number of trades. Okay, and so I was telling you guys that let me see if I can just explain that a little more. You apportion the number of trades you will take in that moment. So now you have to learn to plan with less, unlike before. Okay, so assuming the market was here and it was going down, you are doing a sell. So you apportion the number of trades, with the first part, which will be here up to there. Okay, you apportion the next number of trades there, and then the third bunch over here. So this is A, B, C. Now, in the 5-minute time frame, if now, unlike before maybe you have 100 trades you could take, and then you could do 30, and then 30, and then 30. But once it takes profit, it means you have more. So consciously, you always know once it takes profit over there, then you have more. You have more at your disposal. Take the trade. Once it takes profit, you have more at your disposal. Okay. So in 5 minutes, it's the same thing. The only deal of the 30 trades. You'd be careless to use all your margin. If your margin allows so that you know that the market will probably give you 3 setups, okay, from the high to the low, and apportion the number of trades in each setup. Okay, only when you've taken profit of the first portion or first setup, then you can trade way more than 15, even be 30, and so on. And if it takes all profit, then again you still have more. Okay, so it's a matter of now just being tactful, a lot more tactful than before. You know why? Because this time your losses will be heavier. Your losses will be heavier. All right. Having said that, okay, at this point in time, beginning tomorrow, you are free to release the $1,000 challenge, and now you can graduate yourself to the new $2,000 challenge. Okay. So now we're increasing, doubling the account, the capital, 2,000. Okay. Now we are doing 5 minutes. So we expect you to do, whereas before I kept insisting on lot size 0.01. So now you're free to play with 0.02. All right. Now, if you're very confident, the setup is so good, then you can do 0.05. Again, if you are confident, if you see the market is good and things are doing well, then you can change that. All right. Now that will of course reduce the number of trades you will put, but then it's okay. You will hit your target sooner. Now our goal, the account size, I was still going to insist use the leverage of 1 to 100. That is the more realistic one. Now later on, maybe when we're halfway through this challenge, I will now throw you to the deep end. Where the deep end, I'm saying then the leverage